Hello, I'm Nicholas Wallwork, and today I'll be talking with Lucy from Vantage Finance about financing larger scale property developments. So thank you for joining me, Lucy.
Hi, Nick.
I think this is, hot topic for a lot of maybe slightly more experienced investors that have done a few deals already, maybe done larger HMOs, and they've built up over the years. But everything from, I guess, what we'd term a rip out refurbishment, full rip out refurbishment, right up to tens of thousands of square foot of office or commercial conversions, and everything in between. That larger stuff needs a certain type of product, doesn't it, or various products. So could you talk through for the for the benefit of the viewers at home, kind of what you do, what you've financed in the past, the type of things that you would class as falling under that larger scale development banner, and the types of products you use to finance them?
Yeah, absolutely. This is a really big topic, so I may jump around a bit, so feel free to stop me if you want me to expand certain areas. So you've got, I suppose if we start with acquisition finance, we often get developers, investors that come to us that need to buy something which isn't ready to do the next stage, if that makes sense. And I know that actually we've worked on you with things like this, where you've needed to get planning permission, for instance. So you can't develop it yet, you need to buy it, but it's not ready to build because you want to maximise planning permission, squeeze some more units, maybe a bit more floor area, etc. So we do quite a lot of bridging finance for people where they're either buying something with no planning at all, or something that they want to work up the planning, or it may be that there's a reason that they can't start building it straight away. Because when you go to development finance, the lenders want you to start usually within about a month. They call it a mobilisation period. So acquisition finance is quite a common one for us, and that ranges in value really. We do smaller loans, 100, 200, 300 for houses and smaller plots. And we do them for 5 million, 10 million. So it's very broad, and it just depends on the type of client that we're working with. We've been doing it a long time, so we've built up quite a diverse client range really.
Okay, well that's brilliant to hear. And people shouldn't be afraid of bridge loans. That's what I wanted to jump in and say there. A lot of people are, it's really high interest rate, but they facilitate a deal. They're sometimes they absolutely need to be used to get the deal done, because you can't finance it any other way. Or it might be high fee, but it's for a short period of time.
I think some people still have a bit of a stigma for bridging loans, which I suppose because I'm so desensitised to that, because I do them day in, day out, it actually surprises me when it happens, but you have to take a step back and understand what the customer might know about bridging loans. Now, historically, and when I say historically, I mean 15 years ago, not a few years ago, they were seen a little bit more of lending of last resort. So if you couldn't get a loan anywhere else, take a bridging loan, and perhaps people would see it as not being credit worthy rather than it being as a means to an end to facilitate a transaction. So historically, bridging loans were a bit more expensive. Now, really, you can get a bridging loan at very similar pricing to a development loan. It's just called something different. So it all comes down to the financials on the project and factoring it into your finance costs and your holding costs. And if it still stacks up, especially if you're going for a planning gain, because that usually means that you're adding to the gross development
value.
Exactly. Exactly, because you're adding to the GDV, the gross development value. Therefore, if you have to spend a bit more to facilitate that in interest, it's often worth it. So I always say to people, don't get too hung up on the interest rate. Have a look at what it allows you to do, because otherwise sometimes you can create blockers purely based on stigma and what you may have heard or
and look at the blended interest rate.
Totally.
So you're looking at that that portion there of the bridge loan versus, and that might be for 6 months of a build, and you're going to hold this product for 20 years. And you take the 4 year percent or 3-4% over there.
You have to model it through. That's something that you guys do really well, both for your own deals and for clients. You will look at that longer term outlook rather than getting too hung up on the here and now cost. It's all about what does that allow me to do. So I think bridging finance is actually one of the products which has evolved and come on a really long way over the last 10 years.
More mainstream,
It is a lot more mainstream, So you've got cheaper rates, you've got more lenders, a lot of liquidity in that market. And we have some really professional developers that build 100 units, 150 units, and they will use bridging finance. They'll use it at the front end, and similarly they use it at the back end. So once they've done the development, if they've got 100 units to sell, that obviously takes a bit of time.
Oh, really?
So they might refinance their development loan onto bridging finance to give themselves 12 months or 6 months, whatever they need, to sell out those units, and then they can just move on to something else.
Presumably that's cheaper than refinancing on maybe a traditional mortgage type commercial loan mortgage product with redemption penalties.
It can be, and it can be cheaper when you look at that all-in cost, because you don't often have exit penalties, well, you don't with most bridging lenders now. So the other factor to consider is a buy-to-let loan on that many units. You are in the commercial space, which means that they're judging it on income, and if you don't plan to let them, technically it's not the right product anyway, and the loan to value is often lower, so it works out to be really good on both sides really. And you can use it the whole way through if the cost of works isn't too high. You can use the bridging loan either just to purchase it, then you spend your money, or you can draw down on it if you've got the appropriate bridging product. So it's quite diverse.
Yeah, no, really flexible. It's definitely got more flexible than when I started. I've been property investing and developing for 20 years now, roughly. Wow. So yeah, it's definitely changed, and I use it regularly. Because it facilitates a deal, and the overall cost of funding makes absolute sense to do it.
Exactly, and so I mean, you have to consider how many different arrangement fees you pay, and that's always a consideration.
That can be painful.
It can be painful.
I've had a few of those in my time.
So you just have to make sure you factor all of that into your costs, and if the deal still stacks up, like I said before, it's a case of not getting too hung up just on what you see as a headline rate or the name of a product. You've got to look just at the numbers. If the math makes sense, then
crack on.
Yeah.
Talk to me about timescales. What's the sort of, and I know bridging loan, one of the benefits is getting a loan faster, sometimes in a tricky situation, but what's the sort of quickest you could lend a bridge loan on from day one? Let's say we're talking someone that's got enough track record to get a bridging loan, and we've done another video actually which is worth jumping on, guys, with Lucy on the channel. Look under the finance playlist. About borrower experience and how that feeds into the application process. That's really important. But assuming they've got enough relevant experience and they're readily lendable, how quick can you arrange a bridge loan?
Yeah, so we have done it, and this is the exception, not the norm, but it sounds really good. We have done it in a matter of days. Now, the key is valuation and lawyers, because if you say to me, Lucy, I need this money inside a week, my first question is going to be, have you had a valuation done anywhere, or can we find a valuer that can go out tomorrow and have the report back within a day or two? If the answer is no to those questions, then realistically you are going to be very much beholden to their timescales. Exactly. So
the lender can do it in a week, but if the other people
that are
required to feed into that process can't,
that's it. And to facilitate a transaction in those sorts of timescales, you have to have everybody on board. And they're my favourite transactions when you're working with people. It is a good challenge. And actually we did a development loan that you were involved in recently, where we had a really proactive client, one of the solicitors that you've worked with for many, many years, who is incredibly on the ball. And then my side, I went with a lender who I knew could deliver it. And then we picked a solicitor to act for them between me and the lender, who is also very quick. And then there were a couple of other professionals, valuations and whatnot, that also pulled together. So when you get that, and you get the team of people who all have the appetite to get it done, it's fantastic. And that kind of feeling of rushing through it and making sure that you hit the deadline is great. But it can be done, if we come back to the bridging loan, it can be done definitely inside a week, but you have to be able to get everybody else on board. I would say they very rarely happen inside a week now, and that's not necessarily because people can't deliver it or lenders can't deliver it. It's often a case that people just don't need it in a week. You don't see that as often anymore.
That would be an emergency situation, wouldn't it?
Sometimes it is, or sometimes it's, I've offered on this property and I've told them that I can do it in a week, and that's how I've managed to agree this price. Let's get it done in a week. Or it could be we've had an issue which sort of comes into the emergency situation. We've often had clients that have had problems with their development funding down the line, maybe at legals. There's a point which the development lender that's maybe a bit more vanilla wouldn't take a view on.
Yeah.
But a bridging lender might say, okay, I'm happy with that risk. We charge a bit more for the risk. Therefore, we'll overlook that. We'll allow you to buy it. You've exchanged. You've got a couple of weeks to do it.
Get the hard part out
You
of the way.
can't wait for the development finance. Get that sorted, whether it's a legal issue or a valuation issue, whatever it is. Get that resolved, and then you move on to your traditional development finance.
So it'd be fair to say that bridge loan lenders have a higher appetite for risk, or will allow a higher level of risk.
Yeah, usually.
But they charge for it.
You get different ends of the spectrum. So you've got some which are very vanilla and they will have the cheapest rates, and then you've got everything in between. But then at the other end of the scale, some lenders who will turn their blind eye to a lot of things, but it becomes expensive. It's trying to balance that, isn't it? Because if you need speed, there's no point just looking at the cheapest rate. If it's going to take them 6 weeks to do it, then it's no good. So it's a conversation that we have to have at the outset. When do you need this money by? And what challenges might come up, rather than just saying, when do you need it by? Let's have a look. Has your lawyer done any work on it already? Have they gone through the title information? Have you had a survey done? Are there any pitfalls that might pop up that could be unforeseen?
There are plenty of pitfalls that pop up.
Yeah, absolutely.
So, like you said, building your power team, make sure you've got the right people in your team.
Try and
minimises those risks. You preempt those. You know all the potential risks that can happen, so it all gets preempted.
Yeah, absolutely.
Now you touched upon a moment ago about the valuation. That's all important. If you've got a valuation already, that can be retyped for that new lender. So
sometimes, yeah.
I guess what I'd like to know more about for the benefit of the viewers at home is. Panel lenders, certain lenders have certain valuers on their panel, which can be quite restrictive. As you get more into more development finance and larger scale developments, you often have a bit of choice over which valuer you can choose. You obviously can't influence them by giving them all the right data for your site and they make their own judgment. But choosing it can have an influence, because we know that certain valuers tend to be more conservative on certain types of products. So as you get more experienced, picking the right valuer at a more commercial level can be really important. But for bridge loans, are they much more flexible in terms of who you can pick, or can you reuse valuations, all that kind of stuff?
There is definitely more flexibility with some lenders. And again, when you go back down the vanilla end of the bridging finance, quite often they will have a more restricted panel and they don't allow you to go off. Some of it's lender relationship as well, because if we go to a lender and say, look, this valuation's been done for somebody else, it was instructed by another lender, the customer hasn't gone and got the valuation themselves, they're not on your panel, but they are one of the big ones and their PI covers the right level for this loan amount. Can we get a re-inspection or a retype depending on when it was done? And that's a conversation that we can have with a lot of our lending partners, because we've built up that rapport and relationship over time. They know the quality of the business that we submit. Whereas some will say, no, I'm sorry, we have to instruct it fresh. So that's always an important point, especially around the speed, because if you've had one done for your development lender, that's fallen over for some reason, and we know we need to move quickly. My first question is always, who valued it? Can we go with a lender that will accept that valuation?
Sure.
And it takes a bit of risk out of it.
That's the driver then, the value. We've got this valuation from so-and-so limited. That might drive the lender decision.
It might do, because you might not have the time to go and get another valuation, especially on a bigger scheme, because they don't happen in a couple of days. Sometimes it can take 2 weeks to have a valuation done on something big and complex. Especially where you've got a full development appraisal that needs to be done. It's not just a case of, it's a single house that's worth £500,000 and there's lots of other houses that we can compare it with. It's far more bespoke. So it could be that it does drive the conversation, and it takes a bit of risk out as well, because even if you could have two valuations from two separate companies, and as you well know, they could both spit out completely different numbers. And if you come to me with a valuation, I've appraised the loan and I've looked at it and said, this is what I think we can do based on those numbers. So if we can then use that valuation, we know that that's not an area that could change. Therefore, what we've discussed and what I've said to you should come true, because we've appraised it based on facts. Whereas if we go and get another valuation and they say something different,
pick up something different,
it could pull us back to the drawing board. So it's there's nothing untoward about it. It's a case of just managing the risk and saying that's an area of the transaction that we know is certain because the valuation's already been done, and that way if the lender says yes up front, you know that they will deliver it rather than changing their terms or having concerns later down the line.
It does feel like that's sometimes a better way to go if possible. So it's a nice way to drive it with the valuation because there's less unknowns. That's what's known. Let's get the lending based on it. So
and
it makes sense.
One thing to note on that is that lenders don't like it if you've instructed it yourself. So if
it's another lender valuation is better.
Yeah, if you've gone and got a valuation for your own purposes, not always, but a lot of the time a lender will say it's a bit of a conflict because they want the valuer to look at it purely from
the bank side.
Yeah, exactly.
And
quite right.
Yeah, okay, that's very good advice. So we've talked about sort of the acquisition side of it. Bridge loans are mainly used for that, sometimes used on the end to extend the sales period.
Yeah.
I want to just talk quickly about land and development finance. Can you just talk us through what that product looks like? What sort of loan to value someone can expect on, let's say, an office to residential site. Let's say the purchase price is $1 million, it's going to cost $1 million to develop. What would a typical loan, I'm not going to hold you to these numbers and I appreciate it's an ever-changing market, but rough figures, give or take a 5%. What does a loan look like on that land development loan? How much can you lend?
So it all comes back to the developer's appetite for price versus gearing. So 9, maybe even 10 out of 10 developers want gearing over price within reason.
Within reason.
Yeah, if you come back with a silly expensive quote, that's not going to work either. But most of them want to put as little of their own cash into it to ensure that they've got the ability to go and do other things and they're not confined to maybe 1 or 2 projects.
Yeah, it's not just the interest rate, it's the opportunity cost of getting another 100 grand out you can do another site with. That's going to earn you more than a couple of extra percent, isn't it?
Exactly, that's right. So if we were to say look at what is a reasonably normal loan to value in the market, if we're at the slightly higher end, you can push it even higher, but let's go with the norm. You would be sort of between 80 and 85% of total costs.
Okay.
But there is also another hurdle, which is 60 to 65, normally 65% of the GDV, the gross development value.
Okay. Yep.
So it has to fit within both of those numbers.
Criteria.
Exactly. And the total cost is the purchase price, purchase costs, so your stamp duty, legals, etc. Then you've got your construction costs, your professional fees. Sometimes you might have a SIL payment, Section 106, all those different things. They will look at your total costs and say...
Do the finance costs come in total cost?
Some do, some don't.
Okay,
different
so
lenders
can be fundable if possible.
Okay. Some lenders are different. Some will include it and some won't. So it's quite hard actually to compare development products like for like because of how different lenders will take different costs into consideration. So then you are also confined by that 65% of GDV, but if we look at the loan to cost scenario, what a lender is basically saying to you is we want you to have 15% skin in the game. We want to know that 15% of this total cost is coming from your hard-earned money.
I hate that phrase as well. Skin in the game. They literally want a piece of your arm off, like they're going to chop it off.
It's
brutal, isn't it?
Yeah, it is, and
your
it's
neck
absolutely.
on the line.
It's a very old-fashioned saying that I've heard since I've been in
very
lending.
much used in the finance world, isn't it?
It is. They want to know if something went horribly wrong. Let's just say your contractor went bust. They hadn't done what they said they were going to do, you're really behind, that you're not going to say, do you know what, this is all a bit much, here are the keys, I'm off.
Definitely.
Because you're going to protect not just your upside, your downside as well. If you've got £1 million, 500,000 in the scheme, you're not just going to turn around and walk away from that. Therefore, your interests are aligned with the lenders, and that's what they're trying to do by making sure that you've got enough equity in there.
So there's a lot of detail. Again, I'd like to stress to you guys watching at home, there's a lot of detail in a finance application. Everything from experience of the borrower right through to understanding the different criteria at different stages, total loan to value, total loan to cost. All those intricacies of what Lucy and her team can help with, and why she's a member of our power team. And we've used it for many years over and above lots of other terrible brokers that I've worked my way through over the years and made loads of mistakes and paid way too much interest on and lost deals on. I've lost deals from bad brokers. It's horrible.
We do hear that. We do hear that. Sometimes the wrong product is used at the outset, and it's a bit of a battle sometimes for us, because customers will come and say, I've been quoted this by another broker, and you look at it and you think, that's just never going to work. Yeah. It's just never going to work. Yeah. So then you're competing with something that doesn't actually exist for that scenario. So you're not gonna win the customer over when they've got the carrot being dangled. If it's a new customer anyway, if it's someone that knows us and trusts us, then they will go with what we tell them. But sometimes you get somebody new that says, can you beat this? And not only can I not beat it,
I've tested you on a few things.
You have tested me on a few things.
Let's keep you on toes. That was only early days, but then it's also like just understanding, why is this product being sold to me or shown to me.
Sometimes you have to try it.
I want to understand the detail. And it's really important to, as an investor and developer, to have this level of knowledge of the finance, so that I understand what you're telling me, and I understand when I'm analysing a deal, will it work? So I need to know these rough figures, and the people watching at home doing their own deals need to understand roughly I can get that sort of level of lending, subject to some criteria.
It's always important that you're going to a broker that's got experience in the right field, because there are so many mortgage brokers out there. And a lot of people will say, well, I've used this mortgage broker for the last 10 years.
On my simple buy-to-lets.
Quite right. And they could be brilliant. They could be the best residential mortgage broker, and they've always looked after that customer really well. They've done their buy-to-lets. They've done their children's mortgages and everything like that.
The family mortgage broker.
Absolutely, yeah. But that doesn't necessarily mean that they've got experience in the area that you're looking for. So it may be that they've sought advice from someone else. We get a lot of brokers coming to us to help with their more specialist cases, and we work together to serve their clients. So it's really important to kind of understand that they have the right contacts, the right expertise, and just knowledge in the market, really.
Yeah, 100%. Moving on to one last question for this video, and that's personal guarantees. Yes. Where does that horrible work? Personal guarantees. My house is on the line.
You just asked me that on camera. What are you trying to do to me?
How many millions over the years I've signed up to on personal guarantees, and still I get asked for them after 20 years experience. Why is that, for starters? Tell me why I have to keep signing these horrible personal guarantees, Lucy.
It's a really emotional topic, personal guarantees, and I suppose where I sit is, obviously I've got all my customers ranging from the ones who really don't mind, don't ask a question, they'll sign their personal guarantees and it's fine, to some that the first conversation I have with them is they say, I won't give a personal guarantee. And I normally reply to say, I will struggle to get you lending without a personal guarantee. Now, it's
got so much tougher as well in recent years.
It's got much tougher, yeah.
So much tougher.
It's got much tougher, and that comes from the fact, and it's sort of back to the skin in the game comment, it's although it's not money, it's that thought that you are personally liable. So you bought this project in a company. There is sometimes an expectation from people who don't have recent borrowing experience that, well, I'm not personally liable for it because I'm doing it in a company, but it's not true. Lenders will say, if you stand behind this deal, you stand behind the transaction, you're coming to us saying, we want to borrow money off you and we want you to put your money into this transaction, but I'm not prepared to give a personal guarantee. Well, they'll say, why? What, what
don't you believe in your own deal?
Do you not believe in it? Do you think something's going to go wrong? And the other consideration is there's a loan to value, so they're not lending you 100%. So it would have to go wrong to the tune of
the whole value.
Exactly. So you've got your equity in there, which is going to be at risk if you sell it for less than what you've bought and spent on it. But on top of that, the lender may be at, depending what it is, but let's just say they're at 65% loan to value. For them to call on your personal guarantee, you either have to have stopped paying your mortgage, not paid them back in time if it was a short-term loan, and they have to repossess the property. So that's step number one. So hopefully most people won't find themselves in that scenario anyway.
It's a pretty rare scenario.
Yeah, and if that does happen, then you've got to say, well, is the property going to fall below the 65% that the lenders lent me? And you'd like to think that that is a really unlikely scenario, in which case that would be the only trigger for your personal guarantee. The lender has to sell the property first. They can't just try and sue you for your personal guarantee before they've even had a go at selling the property. And really, over the years, lenders they're under strict rules around marketing the property. I think historically, especially around the financial crisis, there was a lot of bad press with lenders selling properties to people they know and selling things perhaps at less value than what they could achieve in the market. But it's much more regulated now. So in a really unfortunate scenario where somebody has had a property repossessed, it goes on the market and it goes through a proper sales process. Potentially somebody might see it's a repossession and not want to pay full value for it because they think it's a distressed sale. So maybe there's a bit of an impact on the overall value. But for it to go wrong to the tune of your personal guarantee is really unlikely. Some people are worried that the lender might just pull the plug if you've got an on-demand facility, which most development lenders do have. So they can just say, sorry Nick, we've decided we want our money back. Doesn't happen. The facility letter says it, but I mean, I don't remember that happening in my career. I'm sure it has at some point, but I don't remember, and I've never seen a customer that's had that happen to them. Certainly not in the last 15 years. So I think the personal guarantee bit, I come back to, it's an emotional topic. It's that feeling of, is my house on the line? Is my family's, financial security on the line? You've got to make a informed decision on that, but my personal opinion is if you do believe in the deal and it stacks up, you should be prepared to give a personal guarantee. They're normally capped as well. It's not always the whole amount of the loan. It might be 20%, 25%, or it might just be for cost overrun. So it's it's one of those where I think if you want to be very active in the property and development space, you have to come to terms with the fact that you will need to give personal guarantees, otherwise it really restricts your borrowing opportunities, sometimes totally restricts it.
That's very informative. Thank you for answering and spending some time with us today. To end on a slightly more positive note than personal guarantees, which is going to be a slightly deserving ending to the road, just to cheer you all up at home, the positive is that bridge loans can make you a lot of money. Land and Development Finance facilitates the deals. These kind of things help you make money in the property investment world. They help you get your deals done, make money, go on, build something, create value, create something amazing for your customer base and your tenants. So that's an exciting process, and the kind of lending we've been talking about allows all that to happen. So don't be afraid of it. Don't be worried about past stigmas about bridge loans and their use. They have their place in the market and they're used readily by us experienced investors. So if you do have a project that you think might need a different type of lending to get done, or if you actually want to open up your kind of mind in terms of education, in terms of knowing what you can do deals on, give Lucy's team a call, get a quote for a bridge loan, finance loan, and chuck your site across the fence to these guys, and they'll give you some excellent quotes and let you know what's possible. Hopefully you've enjoyed the finance chat today. We've been talking about slightly larger scale developments, including all those kind of finance products that can be used. If you've enjoyed that, please do subscribe, click the bell icon to get notified of any new videos that are popping up. Lucy and I have done a number of videos on the channel and we'll continue to do so. So finance related chat, property investment related chat, everything from HMOs through to commercial to residential conversions, we cover it all on the channel. Hope to see you soon and enjoy some of our other videos after this one. Take care.